Open any social media feed, and you are flooded with the same repetitive images. 20-somethings leaning against luxury cars, working from tropical beaches, claiming they made a month's salary with a single tap on their smartphone. What those carefully curated posts omit are the blown accounts, the 5 consecutive losing trades that preceded that one lucky win, and the sheer volume of people who quietly walk away with empty pockets. The modern foreign exchange market operates on a completely different level. Retail traders are sharing the board with high-speed institutional algorithms that process global data and execute massive orders in fractions of a second. Navigating this environment requires significant capital, hundreds of hours of study, and intense psychological endurance. So, is retail Forex trading actually a viable pursuit? Answering that requires stripping away the marketing hype. We need to evaluate trading as a rigid business operation with clear inputs and realistic outputs. When most people calculate the cost of entry, they only look at their initial deposit. But capital is just the basic entry fee. The actual investment involves hundreds of hours mastering macroeconomics, testing strategies against historical data, and developing the mental stamina to execute trades without letting fear dictate your decisions. This matrix breaks down true expectations. While the myth sells hyper-leveraged wealth, reality centers on strict probability management and methodical growth. This reality column defines success as the ability to generate a sustainable supplemental income stream over a long period. Approaching the market looking for quick action guarantees a loss. The traders who survive treat their accounts like a highly disciplined startup, entirely focused on protecting their runway. Proper risk management requires adequate breathing room. You need a starting balance of $2,000 to $5,000, and it must be strictly expendable money that will not impact your daily life if lost. Once funded, the target isn't doubling the account every 4 weeks. Successful professional traders aim for returns of 1% to 5% a month. This chart shows the long-term trajectory of a $5,000 account. That forest green line represents a 3% monthly return, resulting in a $150 profit. This steady upward curve illustrates the mechanics of long-term compounding over short-term windfalls. Earning an extra $150 a month on a $5,000 investment is a viable side income, but it conflicts with the expectation of replacing a full-time salary within a single year. Accepting this slow pace is the cost of admission. Methodical wealth building is the mathematical requirement to stay in the game long enough to actually profit. The day-to-day mechanics of trading have also evolved. High-frequency algorithms execute the bulk of global volume, making manual set-and-forget trading strategies increasingly difficult to execute. To find an advantage, retail traders now have to invest daily hours into fundamental analysis, learning how inflation reports, central bank policies, and global supply chains interact. Technology is accessible to everyone. Retail traders now use artificial intelligence tools that can process market sentiment and backtest strategies across years of data in minutes, acting as a powerful filter for human analysis. Your edge comes from context. While an algorithm processes raw numbers, human traders can interpret the nuanced geopolitical friction between two nations and correctly anticipate how that tension will impact currency prices. The operational cost of this business is the commitment to never stop learning. You adapt to the algorithmic tools and the shifting economic landscape, or you get crushed by them. Even with the best data and tools, your most heavily taxed resource will always be your own psychology. The ironclad metric of professional trading is risk capping. You never expose more than 1% to 2% of your total capital on any single trade. This graphic demonstrates the strict math behind that rule. On a $5,000 account, a $50 slice is your absolute hard stop. Adhering to this limit means routinely accepting losses. You can take 5 consecutive hits, and the overall equity remains largely intact. The reality of trading is sitting through those drawdowns. You have to process 5, sometimes 10 consecutive losses without losing faith in your tested strategy or suddenly increasing your bet size to make it back. Account destruction typically occurs within minutes, driven by revenge trading or excessive leverage during an emotional attempt to recover a small loss. Long-term ROI is determined by your ability to master your own impulses and enforce rigid mathematical boundaries under stress. Because of these strict margins and the absolute necessity for emotional control, trading is incompatible with needing quick cash to pay immediate expenses. If losing your initial deposit would cause financial distress or alter your standard of living in any way, you must not open a live trading account. This chart lays out the optimal path. The ideal candidate seeks an intellectual challenge, possesses extreme discipline, and accepts small compounding gains. If you align with this profile, the safest next step is practicing execution and emotional control inside a simulated demo environment. Do not put a single dollar of real money on the line until you have proven you can consistently follow your own risk rules in practice. The modern Forex market offers a highly scalable income stream, but only for the highly disciplined business operator. For anyone looking to gamble, it is a guaranteed disaster.